Thanks everyone for joining. We know you guys are busy, and there's a lot of potential economic updates that you can attend, and we always appreciate that you join our one. We do have some interesting stuff to show you today, and hopefully we can keep it interesting on what's traditionally a fairly boring subject, economics. But hopefully we've got some cool stuff to show you today. So just on the agenda, we'll quickly go through our fund performance. I'm very happy with how things have been over the recent times. Then we'll talk about, so what we always do, I think a lot of you guys have been with us for a while, we kind of go out to you guys and we say, what are the talking points you would like to have covered? What are you talking to your clients about? What are they asking questions about? And try and sort of address those instead of us just coming out with what we think are the important things, is also chatting to you guys and getting an idea of what you would like to talk about. So effect on elections on markets, both in South Africa and the upcoming election in the US. What are markets thinking about that? What's going on there? What's likely to happen? Interest rates, still the big story around interest rates. So you look at the inflation story, kind of, that narrative's almost moving on. If you consider the market over time moves from kind of chapter to chapter, so there's always these different narratives. We've kind of moved through the inflation story, and now we're talking sort of potential recession regarding interest rates. So what's happening with interest rates, and where do we think things are going to end up there? Strength of the US markets. Obviously, markets have been very strong despite all the naysayers over the last few years. Markets still continue to do really well. Where are we positioned and how are markets looking? Then specifically an outlook on NVIDIA and the semiconductors. There's been obviously a lot of talk around those, specifically in the media. And then just sort of touch on the importance of diversification and risk management. We had probably you guys are aware, quite a big or sort of protracted sell-off last week in the markets. We believe it was a sort of panic reaction to some data. But just to show you the importance of constructing a portfolio properly and how you can limit the impact on that. Our funds actually came out of that very well. And we'll just kind of sort of speak to how we were able to sort of navigate that and the importance of your position sizing and building your portfolio out. So without further ado, if we just look at the fund performance, so this is just over the last year. This is our 6 funds across the board. You can see low equity, income, medium equity, high equity, flexible. So you see the whole range. All our funds over the last year pretty much well within the top quartile. 4 of our funds actually in the top 10 of their categories. This is up to end of July. Income just short of the first quartile, so ideally we want to get that in there, but you can see still doing very well. And then obviously our 2 high equity funds, we have enhanced opportunities and our managed fund, both sitting comfortably within that first quartile. The reason they look differently is just the way we optimize. As you guys know, we're slightly different in the optimization. This one targets an inflation +5 outcome, whereas this one kind of is just more through a cycle trying to maximize returns. So it takes on a little bit more risk, but it ideally should get slightly better return over time with that more risk. Although these 2 are converging in terms of the way we manage the portfolios, and actually managed currently is owning about 41% of the fund actually is in enhanced opportunities itself anyway at the moment. Just on the 1 year and 3 year numbers. So just looking through there, you can see the 1 year. So all our funds pretty much in quartile 1, well within quartile 1, except income kind of at the top end of quartile 2. If we look further back over the 3 year numbers, you can see some of the numbers. So stable definitely coming through now on the 3 year numbers, well within the first quartile. If you remember, we did do some big sort of process changes and tweaks about a year and a half ago, and that's really starting to come through now. So we're happy with the returns. Ultimately, longer running returns, we think pretty comfortably we can sort of stay within the top quartile in terms of the changes that we've made. If you look at the one sort of standout, it would be managed. We have made a lot of tweaks on the managed. We did come out of COVID quite conservative, considering it is a CPI +5 mandate and equity markets kind of took off. You would expect it to lag slightly, but with our process changes over time, we actually think that that's more likely to do a lot better going forward. So you can see that already coming through. So just wanted to kind of show you the longer run numbers, but over the last year, really good performance, and we're quite happy with it. Getting into the elections on the markets. So it's quite interesting. So there's a lot of news around the election, specifically in the US right now. So what I've done here, what the team's done, is we just kind of printed what the S&P 500 is doing up until, and the reason we use the Biden announcing his exit campaign is if you looked at polling up to Biden announcing exiting, polling was, it was kind of a foregone conclusion that Trump was going to win that race. He was polling well ahead. especially after that debate that kind of went viral. Biden's performance in that debate wasn't very good, and really kind of pointing out what the sort of right of center have been saying for a long time, that Biden was mentally incapacitated, and you saw the whole furore around that. But anyway, him leaving kind of changed things up quite significantly. So what happened is obviously Kamala Harris has taken place, and you see if you look at polling right now, it's much more kind of 50-50 and close again. So, the US election's always going to be close, just the way they structured the federal system, the electoral college system. It's kind of designed to give, generally, unless it's a complete blowout, generally your outcomes are going to be fairly close. And a lot of your states are kind of very much entrenched on where they vote. So you've really got a couple of swing votes that change the game. And that's what kind of causes really, you're talking about two or three kind of swing votes on different states that are actually going to determine who the next president is. Other than that, it's pretty much a foregone conclusion of who's voting where. So, but you can see, so back to a very close race. But you can see, so this was kind of, treasury markets before the move and equity markets before the move, and then after the move up till kind of, a few days ago. And you can see equity markets kind of flat. They haven't really moved. And treasury markets have run up, but that's more due to the sort of sell-off that we saw last week more than a political situation. But you can see, compared to how treasury markets have moved running up to that announcement, not really changing. There's not any more volatility in the markets or anything like that. So you can see that although there's a lot of media hype and talk around the elections, if you actually look at its effect on markets or big changes in the sort of political landscape, this you could consider to be quite a big change. Biden announcing his exit from the race, the current president announcing and saying he's not going to run again, where the whole market was expecting him to. You can see that things don't change that much. So the reaction on that news from the market point of view was actually virtually zero. Going into the markets, it's quite interesting. So if you look at this is the S&P 500 since the 20s. If you look at the 12 months before the election and the 12 months after the election, regardless of who wins, Democrat, Republican, it's not that important. What generally happens is, running into an election, you kind of get what we're going through now. You get a bit of volatility in the markets, you get uncertainty. It's kind of one of those, you see this a lot with big events or big expected events. There's usually a lot of uncertainty and kind of indecision coming into the whatever happens, the announcement. But then post the announcement, regardless of what the announcement actually was, you can see kind of almost a relief in the markets of just knowing, markets they like to know what's going on. They like certainty. So generally what happens is you get this sort of volatility and no real direction in the markets. And if you look on average since the 20s in the S&P 500, the 12 months leading into an election, regardless of who was running, regardless of who got elected, fairly flat 12 months. I mean, it's slightly down, but statistically speaking, you're talking about a flat directionless market. And you've really seen that for the last 6 months in the US markets, if you think about it. I mean, and probably you would probably see a little bit more volatility and kind of no direction until the election happens. But post the election, you generally see a relief rally, regardless of who wins the election. So you're seeing a sort of a big jump up after that. So that's the things you've got to be aware of. Is coming into the election, there's going to be a lot of media hype, a lot of talk around it. But ultimately, the markets will kind of do what they do and probably be up and down, based on the short-term kind of numbers that are out, but you really want to see post that election what's happening after that, and that's really that's where I think the investment opportunity is. So, we'll talk about equities, our general view on equities a little bit later, but generally still bullish on equities. But just bear in mind that before the election, there's going to be a lot of noise and probably a bit of volatility in the markets. But really longer term, it kind of irons itself out. This was since the 20s, so you can see sort of 8.3% return. If you look since the 80s, if you look kind of as interest rates have gone down over time, equity returns have kind of done a little bit better just because of your equity risk premium. But if you look average return on the 12 months after the election, actually quite significantly above the average. So you're sitting at about 16.5% S&P 500 returns in the 12 months after the election announcement. If you look at the media, so I mean, if you look at these numbers, you can look minus 21% there. That was 2000. That was obviously the dot-com boom. So that was not a political outcome. That was more of an economic one. But you can see, sort of take the median, so you take these sort of tails that can kind of adjust your mean. But if you take the median, 21, 22% return. So it's quite bullish. So you really want to be invested in the markets, statistically speaking, just after the election gets announced, regardless of who wins it. you just look, markets through Democrat and Republican kind of run terms. I mean, this is a log graph, so you're generally wanting to see that as a straight line, meaning consistent, percentage returns, so compounded returns over time. And you can see it's running at its long run average, kind of, 10 to 12% per year. Doesn't really change based on who's in charge. You can see there are some areas where you get market crashes and market corrections, but those aren't politically induced. You could argue certain legislation can lead to them over time, but really the impact on, this was the global financial crisis, this was COVID. And you can see, this was the taper tantrum here. So you can see these things happen, but generally over time, you're actually getting a fairly stable outcome regardless of who's in charge. Really, and that's the important thing about the American system. It's designed to be extremely robust, and it's almost, other than the media hype, it's almost irrelevant who's in power. The things that happen in the background, the Senate and the House, your kind of houses of parliament really run the country. And that's way more important than actually who's in charge as president, although everyone likes to look at the big dog, I suppose. Also, just on that, it can be quite counterintuitive. So markets in general kind of do what they're going to do and are generally getting their long run returns on earnings and economics. But they can be quite counterintuitive at the industry level. So this is quite an interesting chart I had the guys draw up. It shows you the relative performance of clean energy versus traditional fossil fuel type energy. And basically, when this goes up, what it's showing is that clean energy is outperforming traditional energy. And then if it's going down, clean energy is underperforming traditional energy. Now you can see that during the Trump term, 2016 to 2020, his second term, you can actually see that the relative performance of clean energy far outdid the relative performance of traditional fossil fuel-based energy, which is quite interesting. You would expect it to be the other way. And then when you have a sort of more favorable president in charge of renewables, you actually have the reverse. So it's very counterintuitive. So trying to predict markets or run markets based on what's happening in the elections it's kind of, you're not going to get very far. And it's because of things like these. What actually determined these run-ups had nothing to do with policy. It had nothing to do with politics. It had to do with relative valuation. So you can see that sort of clean energy traditional. I mean, if you'd asked a betting man in 2016, or let's say in 2020, when Biden became elected, which stocks are going to do better, traditional or clean energy, I think most betting people would have said clean energy. And you can obviously see clean energy actually got wiped out compared to traditional energy sources. So just an interesting concept. We actually ran the same chart with just sort of very controversial subsectors, but we did it with firearms, and we also did it with, there was another one. It was firearms. The analysts will be able to tell me later, but the one was firearms, and you actually saw the exact same kind of trends. It's quite interesting. So globally on the US election, expect a lot of hyperbole, a lot of rhetoric coming into the election. I expect the markets to be a little bit volatile, but ultimately, I think once you see that election being announced, I think you'll see markets rally regardless of who's elected. Statistically speaking, that's what's happened in the past. So just be aware of that in the markets, but we do still believe, that long term, if you look at economics in the US, economics globally, we're still quite bullish on equities. Moving to South Africa, post the South African elections. So you can see South Africa is a little bit different. Our system is we are a constitutional democracy, so we do have the constitution to protect us, but our actual legislative, let's call it, checks and balances aren't as robust as in the US. We have a different electoral system. We have parties that can gain much more than, much higher percentage of the vote, and obviously their policy can make a much bigger difference. So you can see, obviously after the election announcement, I think this is, pretty wide knowledge. You can see that both local shares and local bonds rallied quite heavily. So you can see, compared to what they were doing coming in and what they've done going out, you can definitely see there was a positive reaction to our election, okay? And then you can see since then, things have sort of tapered off. So bonds have kind of re-rated. So our bond, we're running a bond premium of around 2-3% quite consistently before the elections. And that premium, although we're still running a premium, has come down a bit. So if you look at the All Bond Index, the 30 years, we're sitting at about 13% post-election. Now they're sitting at, in the sort of around 10-11. So you can see that the premiums come down, but then it's kind of re-rated. So it's almost a re-rating in our risk premium. So you saw that re-rating in our risk premium. Now, what does that do to markets going forward? I mean, the GNU is still very much untested, and we need to see how it plays out in terms of policy and how it impacts the economy going forward. But you can definitely see the positivity in terms of the risk re-rating, the risk premium re-rating post those elections. You can see that quite clear jump. So very different to the US markets. US markets after that Biden announcement, not much happened. But in South Africa, you can definitely see that change. So obviously obviously I think as most people are quite positive around the prospects in the GNU, but still very much a young concept. And it'll be interesting to see how it plays out. But for now, we still like the bond market and the equity market locally. But you can definitely see how that jump has affected the markets. Interest rates. So if we look at the US, so inflation numbers. So look at the blue line. That's just your general sort of broad market CPI inflation. Then you've got your core, so that would be your headline inflation. Your core inflation is the orange number. That's just taking out food and energy. You generally want to take that out just to get an idea of the trends, because food and energy can be quite cyclical. So you can see that how that orange line is, although it moves, less cyclical than the blue line. So just give you an idea of, food and energy kind of moves around. It's very supply and demand driven. And then you've got the gray line, which is actually inflation less shelter. Okay, so just taking out shelter, and I'll isolate why we've removed shelter from those numbers. But you can see inflation on all counts kind of coming down. Still your core inflation, which is actually the number the Fed actually uses a core measure of inflation to measure. They use PCE, but it's the core PCE that they would use, but it's a similar number. So they're taking out food and energy, and they're watching that number and seeing what it does. And you can see at their target, still fairly, you can argue how arbitrary a 2% target is. We think still fairly arbitrary, but based on their policy decision, you can see that those numbers are coming down and kind of in line with where they want to be. And you're already seeing the Fed start to talk about rates coming down, rates being reduced. And I think you'll see that probably got a good chance of a cut in the next meeting, probably a 25 bips cut. And we'll talk about that now. The reason I've taken food and shelter out of this, you can see that if you take the shelter number out of this, inflation's already sitting at 2%, which is kind of where they want it to be. Okay, now if you look at the breakdown of inflation, this is the breakdown of the headline inflation. You can see so the food kind of doing what it's doing. You can see everything kind of in line. A big contributor to US inflation is still owner's equivalent rent. Okay, now if you pull that on, you say, what is owner's equivalent rent? It's actually not a real number. It's not a real economic number. What they do is they essentially will survey property owners, and they'll say, what if you were to rent your property? Or if you are renting your property, if you were to, what do you consider your rental increases that you want to push through to your clients over time? So what do you think those rental increases are going to go up by over time? And that's a very lagging indicator in the economy, because what it's doing is saying, like, so I'll phone you up and I say, okay, you're renting a property now. How much are you going to charge additional rent to your tenants once your agreement kind of comes up for renegotiation? And you're going to use the current inflation numbers to kind of give an idea of what you're going to charge going forward. So as inflation moves through the system, the owner's equivalent rent, as not being a real number, kind of lags that. So it's quite, it's debatable whether this number should actually be included in the official inflation basket. You could argue reasons why you shouldn't, but ultimately it's a lagging indicator. And it's still causing the official inflation number to be higher than that 2%. So just to be aware, so we think, and what generally happens is, as that inflation number comes down over time, so does the owner's equivalent rent, but it's usually a 6 to 12 month lag on that number. So you'll start to see, all else being equal, if inflation stays under control, all else being equal, you'll see the inflation number just decreasing anyway because of that owner's equivalent rent number coming down. So ultimately, and I think the Fed is very aware of this and they understand this very well. So even though inflation is not at the 2% target yet, inflation is under control. It seems to be, the kind of whole story of the inflation narrative. As I said, markets move from one narrative to the next. I think that inflation narrative, you could close the chapter on this one, I think, moving forward. And if you look at what's happening in terms of rates, if you look at the Fed's dot plot, so this is, they take all the Fed committee members basically, and they say, where do you think interest rates are going to be going forward? So currently that striped line, that's the current Fed funds rate at the moment of where it sits. All the members were, this is in the last meeting. So this is, I think, what, 8 weeks ago meeting. Something like that. You can see that already the kind of most of the kind of members are sitting there. So they're already sitting at a sort of 50 basis point cut by the end of 2024. So that's the committee members telling you themselves that at the end of 2024, already from these levels on average, you're going to see a 2% cut from them. At the end of 2025, you can see that comes down quite significantly. It's another 75 basis points. And then at the end of 2026, another 1%. So you're talking about, 2.25% over the next 2 years on cuts. If you ask the Fed committee members themselves on what they think is going to happen. So it's quite interesting. So just following and listening to the Fed, and this was, I think you probably see in last week's volatility in the markets, futures had repriced. So currently futures are pricing a high probability of a 25 basis point cut in September. Last week, they were actually pricing in about a 93% probability of a 50 basis point cut in September. Now that's come back a bit, but it shows you that probably the Fed, after this kind of market volatility of last week, probably the Fed is still looking, it's still a little bit more dovish. So kind of expecting rates to come down quicker than they were during this meeting. And you can actually see that in the futures market. So that futures market, the orange line is actually what futures are pricing and of where they think rates will be. So futures are a little bit ahead of the Fed in terms of where they're pricing right now. Futures are actually saying, take another 50 basis, so actually 100 basis point cut, 100 basis points of cut by the end of the year. And then another probably, they're actually expecting that you're going to get the full, so where the Fed's saying end of 2026, the futures market's saying you'll hit the end of 2025. So probably a little bit ahead of the Fed, but it also gives an idea of where the Fed's kind of leaning to. And you'll probably see in the next dot plot, these numbers will actually be lower than where they are now. So if you look at the market's expecting about 325 bip rate cuts, basis point rate cuts to just at the end of this year. And we think this actually creates a massive opportunity in long run US Treasuries, which I'll talk about just now. If you look at South Africa, inflation pretty much in control. So we actually have a much better inflation targeting system. We use a band. So we have the 3% to 6% band that we target, as opposed to a point estimate number that the US looks. And I think it's probably, you could argue both are fairly arbitrary numbers, but probably a better number to look at would be a range, just because of the natural kind of ebb and flow and volatility of these numbers when they come out. But you can see well within. So if you look at our core inflation, that would be the black line, very much in line. And then if you look at less food and energy, as I said, obviously food and energy being a little bit more cyclical, and you can see how that black line moves around a little bit more than the orange one. Food and energy pretty much smack back on at the midpoint of our targeted inflation range and what we want. So, and if you look at the breakdown, pretty much across the different subsectors of the basket, you're looking at pretty constant. There's kind of no areas where you're seeing a sort of spike or anything like that. So inflation fairly benign and under control locally. When do we drop rates? We wait for the Fed. So we won't drop rates before the US Fed drops. So if you've seen, all the big banks have already dropped. So I mean, if you look at the ECB, if you look at the BOE, they've dropped rates. Canada's dropped rates. Switzerland's dropped rates. It's really the US that's the big bank that's still kind of waiting. But I definitely think you will see a 25 bip cut in September. And off the back of that, you'll probably see a 25 basis point cut here as well. We would probably have cut already. The reason we haven't is just essentially ultimately to protect the currency and nothing else. So if you're looking for kind of consumer, a little bit of ease in the consumer, I think you'll start seeing those rates coming down. If we just look at the SARB's repo forecast, so this is the South African Reserve Bank MPC forecast, you can see that, repo is kind of sitting there right now. That's the number where we are now. And that's kind of the predicted repo forecast over the next year, say 2 years out. So you can see they're predicting about 100 basis points cut on average over the next 2 years. If you're looking at the Fed, the Fed's predicting much more aggressive. So if you look at their dot plot, they're looking at 200 basis points over the next year. So anywhere between, you kind of 100 balance of probabilities, 100 to 200 basis points worth of cuts over the next year, 2 years, both in the US and SA, which is going to obviously alleviate the consumer quite significantly and should be fairly positive for both equity and bond markets as well. And that's why we're still quite positive. We look specifically at the US markets. We have a lot of questions around, US markets have run very hard. What are the prospects going forward? So if we just look at, a couple of just points and why we still favor them. You know, if you look, I mean, the US is still the center of innovation and research. If you're looking at equity markets, what drives them long term is earnings, and what drives earnings? Innovation, pretty much. Bringing out better products, bringing out better services to the market, and that's generally what drives the economy. Any kind of tech guru or anyone who wants to make money in innovation and tech will do it in the US. Generally, you know, that's where you want to be doing it. So we still think very supportive of that innovation and research kind of component into the economy. That's the US market. It's known for that historically. That's why the US market does so well. It allows innovation to kind of happen, and with as least amount of regulation as you can see. You know, the reason we still don't like Europe in terms of developed market potential investments is just we still think that they're over legislated, they're over regulated. It's hard to get good, solid, strong economic growth when you get crowded out by regulation and legislation. So still think the US is the place to be. Access to capital, obviously the capital markets in the US are extremely deep, skilled workforces, large markets. You know, the economic and political stability is there. I think regardless of who wins the election, you know, if you put all the rhetoric behind you and the media hype, the economy will be fairly stable regardless of who's in there. And the checks and balances that are in place throughout their political system will continue to be in place before and after the election, as they have been in the past, if you look through all the noise. Business-friendly environment. So that's, you know, kind of the economic reasons why we still like the US. If you look at that said, you know, you saw quite a big sell-off in global, not just the US, you saw a big sell-off in global markets last week. It kind of spooked a few people. We've sent out a lot of WhatsApp notes and a lot of email notes around it of what we thought was happening. But just to kind of cover it basically, you know, we think the weaker, so the US had unemployment data that was released last week, was expected to come in at 4.1 and it came in at 4.3. Now, if you add that onto the back of, you know, some of the companies coming out with slightly, so if you look at the big tech stocks, Amazon, Intel, they had slightly weaker numbers last week. Add onto that, Warren Buffett selling half of a stake in Apple. So, you know, people talking about this. Still, Warren Buffett actually, it's even though he sold half the stake in Apple, it's still actually his biggest holding. So he can't hate it too much. I think he was just rebalancing his portfolio. But, you know, these were kind of things that you saw in the market of what was going on. And these are some of the theories of why that market did what it did. And then probably quite a big one was the Bank of Japan actually increasing rates. So they actually increased rates by 25 basis points. They're kind of doing their own thing. The rest of the world is dropping rates. Bank of Japan's and China to an extent doing their own thing. And that led to the unwind of the carry trade. So what happens is, a lot of Japanese investors, a lot of Japanese money will essentially, or a lot of investors globally will borrow money in yen because the rates are so low. And then they'll invest that money in bond markets globally. And then they'll make money in what's called carry trade. So they have to pay back very low interest rates, you know, in Japan, you know, zero, basically below 1 interest rates on their borrowings. But even in the US now, you can get, you know, north of 4% on a US Treasury bond, and that difference you can fund. So you can fund your loan difference by the difference in those rates, basically. And that's called the carry trade. Obviously, with the Bank of Japan raising rates by 25 basis points, it kind of changes the economics of that trade a little bit. It makes it a little bit more expensive to trade in yen. And you saw an unwinding of that quite significantly in the Japanese market, but we think also kind of moving into the global market. So if you look at the Nikkei, the Japanese stock market, actually dropped 12% last week, Monday. Quite a significant drop, just because of that carry trade. But you saw that kind of tapering off into the rest of into the global markets. But we think that was ultimately the reason for that sell-off last week. We think it was a panic sell-off. We don't think it's, and you've already seen kind of recovery, you know, through the rest of the week and into this week. You've started to already see that recovery. You've already seen tech turn around as well. And we just think, but you know, again, you get these kind of sort of market jitters, but you kind of got to be able to look through that and see what's kind of the bigger picture and what's going on. So really, to answer anyone's questions on that, we do think it was just a bit of a panic sell. I mean, if you look at the economic data, 4.3 versus 4.1 is not a massive statistical difference. I mean, these numbers themselves are exposed to a bit of noise. The trend is more important than the actual unemployment rate, which we still think is under control. So, you had these increased fears of recession and a hard landing. But I think ultimately it was a buying opportunity more than anything. And explain a little bit later how we took advantage of that. Just on the kind of valuations of the US markets. So if you look at the mega cap, we talk about the Magnificent Seven. Those are your big sort of seven big tech stocks. We took the mega cap 8. So just your 8 biggest stocks in the US market in the S&P 500. So this orange line is what their price to their forward PE. So their price to earnings over the next 12-month expected earnings. What is that number? That dotted line is the average. So you can see these stocks have always traded at premiums to the market. And the reason they trade at premiums is because they're in that growth, they're in those paradigm shifts. The reason they are the biggest stocks is because they are the stocks that are taking advantage of the paradigm shifts in the market. So it kind of makes intuitive sense of why they would always trade at a premium. They are expected to have higher growth, and higher growth stocks obviously command a higher premium in terms of valuation. So you can see, if you look at where the forward PE is now, 27.6, and I'll kind of digest these numbers a little bit more in the next slide. But so if you look historically, slightly above average, but nowhere near kind of bubble territory or anything like that. And I'll specifically call out compare Nvidia just now, but nowhere near above. So slightly above average in terms of valuations. If you carve out the mega cap 8 and you just look at the S&P 500 excluding those, or if you just look at the S&P 500, it's sitting on a kind of 20.2, so it's also slightly above its long run average. But if you look over the last sort of decade, not actually kind of that average has come up over time. And then if you look at the S&P excluding the mega cap 8, it's sitting at 18.7. So, above its long run average, but not significantly so. So we don't think that equity markets are anywhere near bubble territory, and not anywhere near where we think, you're not getting still decent value going forward. Now, you could say, well, okay, they're still above their long run returns. So, should you not wait until these things get below their long run returns or their long run valuations, let's say, to invest? And the answer is that would be a hard call to make because earnings are still coming through very positively. So if you just look at the S&P 500 earnings coming through, earnings are still beating expectations on a consistent basis. So what this looks at is each sort of subsector of the market, energy, financials, all the rest, technology, communication services, and you can see that so what happens is you get the expected earnings numbers. So this price is based on the expected earnings numbers over the next 12 months, not the actual earnings. If earnings continue to beat expected earnings, which they are doing fairly consistently, and what we think is still kind of will be intact going forward, you would expect that these valuations priced to forward earnings would actually come down over time, even if the market continues to rally or even just stays flat for a while. So you want to be careful that you don't try and time this. It's not always, if you correlate the valuations of markets versus subsequent returns, the correlation is virtually zero. And it's because valuations alone do not determine the market going forward. It's actually how does the earnings unwind. So you're prepared to pay more for a company. If you consider, if you had bought the mega cap 8, even at a premium over there versus the rest of the market, you would have still have done better over time because it continues to be at a premium. And the reason it continues to be at a premium is because earnings growth is so much higher. And that's what you really look out for. And that's what we're looking out for. So earnings growth, we run our earnings growth numbers every earnings cycle to see how much those earnings are beating kind of estimates. And on average, you're sitting at about still, on the S&P 500 is 7 to 8% earnings beats over time through those estimates. So if you take, just in the next 12 months, just 8% off that number, you're sitting at kind of the averages. And that's what the market's seeing as well. So, ultimately, the point of this chart is, yes, you could look at the markets and say, based on estimated earnings, are they expensive? A little bit, not severely, but earnings are actually still coming through quite nicely. And economic numbers are still quite strong. If we look at just kind of delve into that a little bit deeper in NVIDIA and semiconductors. So what we show you, people are saying NVIDIA's run very, very hard. Isn't it due to pop? What's going to happen? So this orange line is the forward PE. So it's the price of NVIDIA's share divided by its expected earnings over the next 12 months over time. And you can see that it's actually kind of sitting at more or less its long run average over the last 30 years. okay, 25 years, let's say. Now people are saying, well, is it not a bubble? You know, you're hearing a lot of this tech bubble, you know, Nvidia's making the headlines with everything. You know, let's compare it to an actual bubble. So if you look at the blue line, so blue line would be Cisco. So the reason I've used Cisco Systems, you know, it's a sort of telecommunications company. It was kind of the darling of the dot-com bubble, where back when the dot-com bubble blew. It was one of those stocks where you made a fortune on it, but you also lost a fortune on the way down. The company still exists. It's a large cap. It's in the S&P 500. It's actually done fairly well for investors post the bubble. But basically what I want to show you here is that at the top of the tech bubble in 2000, Nvidia was on a forward PE. So this is based on what investors expected it to earn. It was on a forward PE of 100. Okay. Now, then you consider that bubble unwinding, its actual earnings coming out was way less than what investors thought it would be. And it obviously crashed along with the tech bubble. But since then, you can see its forward PE has been fairly benign. It's sitting at about a 12.8 forward PE now, but it's not really a growth stock anymore. But on the contrary, if you look at Nvidia, Nvidia is sitting on not a forward PE of 100, it's sitting on a forward PE of 32. So you can say, okay, is that expensive? Well, not compared to its historical average. And if you look at its earnings expectations coming through, still very good earnings expectations. So you can see those earnings expectations were a lot more hyped up a while back, but currently they're sitting at about 46%. So what it's saying is, and this is 5-year estimate. So what it's saying is the expected 5-year compounded earnings growth of NVIDIA based on what analysts are expecting is about 46% a year, okay? Now that could be hyped up, okay? So what we did was a calculation. We said, okay, well, what if those earnings expectations, what if you didn't hit that and you only did half of that? So you did 23% in earnings growth a year. We think NVIDIA is going to do a lot more than that, and I'll explain why later. But let's just say over the next 5 years, it did 20% a year in earnings growth. At current valuations in 5 years from now, it's putting it at a forward PE of about 11, which is actually where you would probably find most value stocks at the moment in the markets. So although it looks expensive on a forward PE at 32 there, you can see definitely not in bubble territory where it's been in the past. But also, if you look at the fact that earnings growth is expected to come through quite significantly, it's actually not that expensive, even though it's run very hard. You can see, so Cisco, on the other hand, Cisco is trading at a much lower forward PE, but you can see its earnings expectations are also a lot lower. It's only expected to have a compounded earnings growth rate of 2% a year for the next 5 years. And it's trading at 12 PE, whereas NVIDIA is trading a lot more expensive, but its earnings growth is a lot more high. Now, you might say, okay, what's this anomaly here? So NVIDIA has always been a good growth stock. It's always had, 20, 30% earnings growth. But, why has that gone up of late? And that's really the sort of AI, let's call it paradigm shift. So, what's going to happen with AI? What's going to happen with chips going forward? So if you look, NVIDIA's in a very interesting space. It provides chips, and it's the only company that does it to the hyperscalers, which are the guys that are building the big data centers. And it's the only company that does that. And the data centers are really in a race to kind of build capacity. And the data center guys, so your Amazons, your Googles, your Apples, all those guys that are into that are in that space, Microsofts, they're actually in a kind of almost like an arms race to build out as much data center capacity as they can, so they can take advantage of smart technologies going forward, if that makes sense. And NVIDIA is just in a fortunate position that they're the only guys that can provide those chips right now. Now, at some point, competition will come into that space. And as you know, guys who have invested with us for a while, we don't stock pick, we buy themes. But that's why we like the semiconductor theme in general, is because even if NVIDIA ends up not being the winner, one of the other competitors might come through and end up, that's why it's hard to pick the stock, but you can definitely look at the theme. And we still think the theme is a massive plus. So if we go into the themes, and what we've done here, when we look at our thematics, we're looking at paradigm shifts. And these are the sort of last big 5 paradigm shifts, in the market that you've had over the last year. So in the 90s, you had the PC era, when PCs it was a big technological paradigm shift of the age. And you look at the big winner out of that market, Microsoft. And Microsoft, through that decade, went up 30 times. Okay, so you think to yourself, even if you hadn't bought it there, and you probably bought it there at quite a high PE rating, but even since then, even if you had done that, you still made a lot of money. And the reason is because these paradigm shifts the potential earnings that come through them aren't really predictable. You look at different markets, so you can consider that PC era coming in. It created new markets that didn't exist before that, and that's really why you just had a massive just demand for PCs at every level of I mean, you had it on the personal level, you had it at the work level. I mean, it was a massive boon for the PC era, for the PC market, and that's why Microsoft went up 30 times. If you look at Cisco, so I've included Cisco in here, and that was really the .com PC, .com internet era. I mean, Cisco went also in the 90s up till 2000, it went up 80 times. Okay, not 80%, 80 times. So 1 Rand became 80 Rand over that time period. If you look at the mobile era, Apple went up 100 times during that mobile era. Social media, let's just take Meta as an example. Meta went up close to 20 times during that social media era, the late, and this isn't since it was founded. I'm just talking about when social media, you had the rise of YouTube, you had sort of Facebook becoming large scale usage, you had Twitter, that social media era. And even over that period of time, Meta still went up close to 20 times. Nvidia through this PC era. So if you look at this era where you've got this sort of huge rise in expected earnings because of this paradigm shift, has gone up about 5 times. Okay, so it's gone up a lot. You've made a fortune on Nvidia. But compared to these other paradigm shifts, you can still see that it potentially has a lot longer to go. And that's why we like the tech space. That's why we like the semiconductor space. If you look and just, it's a silly example, but just if you had to average the return on these, you would have been at about a 50 times return. Nvidia sitting at 5 times now. Based on, I'm not saying, I'm just having a bit of fun here. I'm not saying that this is what's going to happen necessarily, but if it did, the average of what all these guys did, you could still have 10x from here, 10 times your return from here over the next decade. That's not a prediction, but we definitely do like the tech space for this reason. So we still think, and we think that this little sell-off over the last few weeks in tech has actually provided a good buying opportunity. So you can see, semiconductors and the NASDAQ have sold off a little bit. And we do think, ultimately want to be buying these dips. You actually want to be buying the dips into these paradigm shifts and definitely not selling right now. So if we look at those drawdowns in a little bit more granularity, so we can see, this is just over the last month. So that black line would be the S&P 500. It's corrected by about 6%. Just sort of normal market volatility. The NASDAQ's down about just over 10% at the moment. But if you look at your Nvidia and your semiconductors, they're actually down about 22%. So they're already in a bear market. They've already come down quite significantly from where they were, and arguably a good entry point. And the point I want to make here is that, the importance of diversification and risk management, crucial when it comes to constructing portfolios. So if you look at it, we like tech, we have exposure to both semiconductors and the NASDAQ. Now, if you look at our fund performance, and I've shown you the performance numbers at the beginning of the presentation, performance numbers have been phenomenal, even in light of this happening. And the reason being is our position sizing is correct, and we're diversifying our portfolios. You want to diversify your portfolios very well. So the two aspects and the two things you really got to get right when it comes to portfolio construction is the one is your position sizing. So if you're going to take exposure to a theme or a sector, make sure that your position sizing is correct. And number two is make sure that you diversify correctly between asset classes. So 2 weeks ago, we actually made the call. We saw a good opportunity in long run US Treasuries, and I'll talk a little bit about why we saw that good opportunity later. We still think that thesis stands. What that did is, and the reason why we like it is we think long run, and if anyone has been coming to our economic updates, we've liked SA bonds for a long time. We continue to like them. They've done very well for us. But now we're starting to see those same opportunities in the US long run bond market. When I'm talking long run bonds, I'm talking 10 years plus. The reason we like that part of the market is currently you're getting a yield of north of 4% in US dollars on that basket of treasuries. If you combine to that, predicted sort of long run weakening of the rand just on inflation differentials of another 3 to 4%, you're already kind of looking at 8% in rand terms on those treasuries. Then if you throw into that we're at the top of a market of an interest rate cycle, not of a market, the top of an interest rate cycle, and interest rates are predicted to come down from here, as I've shown you, you probably get some capital pickup on those too. So what we did a few weeks ago is we made an allocation shift across our portfolios where we sold some local equity and we actually bought some long-run US treasuries. So one, you're getting the return, but also you get a nice buffer in times of panic. So if we do think, the markets have run fairly hard, you probably will get some volatility up towards the election. Long run, we still really like equities, but in the medium term, you could probably get a bit of volatility. This is what happened. So if you look at the sell-off from last week, in the S&P 500, you can see it came down quite significantly. It drew down by about from its high, about close to 8%. Started to recover, and it's recovering this week, but you can see that drawdown. Treasuries at the same time actually rallied quite heavily and rallied up to about 7%. So in 1 week, equity markets dropped 8% and treasuries ran 7%. So you're getting a good hedge. And the reason that is every time you get sort of panics in the market, uncertainty for whatever reason, what happens is investors flee the risk assets. They flee South Africa, they flee risk assets globally. You get a weakening of the rand, and where do they put it? They put it in US treasuries. So they put it across the board into US treasuries. They put it in short run and long run treasuries. They're seen as risk free, but generally your long run treasuries will rally more because basically what's happening there is the interest rate predictions come down quicker than they would have otherwise. Because the Fed's in a very healthy position right now that it wasn't in 3 years ago, is that now they've got a shock absorber in the market. So if you do see economic pain, currently rates are sitting at 4-5%. If you do see economic pain, they have a lot more space to drop interest rates. Whereas before, when rates were at 0 to 1%, they didn't have space to actually drop those rates. And that's what we like about this opportunity in the treasury market. So if you look, as I mentioned to you, we actually sold some local equities and bought some offshore long run US treasuries. And you can see, just going back, this is a chart in rands, just to show you the cyclicality and the hedging benefit that you get from these two asset classes in combination. So if you look in rands, if you're a rand investor and you invested in long run, so 10 plus your US treasuries 20 years ago, in rands, you would have done 9.2% per year return. That's through a market where you actually had zero yields for a long time. But the reason you got these returns was because of the rand depreciation, essentially. The blue line is if you had bought equities, just normal all share 20 years ago, you would have done about 10.2% a year. So not really a huge difference in terms of return, but you can see the cyclicality. So you can see that generally what happens is equities do well, treasuries lag a bit, then you get a panic. So this would be the GFC, the global financial crisis. You can see what treasuries did during that panic. You can see what shares did during that panic. So actually over this period, if you were a rand investor from point to point, you actually did better in US treasuries as a rand investor than you would have in equities. Both are just as volatile. You can see the volatility moves both. The reason the treasuries are volatile is because of the rand dollar. But you can see that they're providing you that nice hedge in times of panics. Again, you're seeing it over here. So this was COVID. So you can see panic in the markets, treasuries rally. So you can see you sort of had markets doing well, you had a reset in the markets. Markets recover, treasuries still do fairly well, actually, and then you have a reset in the markets. This was actually the taper tantrum, if you all remember the taper tantrum in the early sort of teens of sort of 2015, around about there. Then you have the same thing. Then markets kind of do what they do, recover a bit, treasuries kind of volatile, but then you have the next sort of reset in the markets, and that happens. So what we believe is you can see this differential is actually widened quite significantly. So it widens, contracts, widens, contracts, widens, contracts. And we think that not only are you, so we're not trying to time the next crash. We don't know when the next crash is going to be. Economically speaking, we still like equities, we still like bonds. We're actually quite bullish across asset classes. And the reason we are is we think you're at the top of a rate cycle, and we think that rates coming down is actually going to be constructive for all asset classes. But what we are saying is you're not giving up by de-risking your equity holdings a little bit. You're actually not giving up much return on the long run, and probably going forward, when that next event does happen, you're actually going to be quite well hedged. So you have a really good hedge. Now, we made this trade but just by chance about 2 weeks ago, and it actually held up really well last week for us. So if you look at our funds through the week, actually didn't draw down that much, even though you had that big protracted sale. It's just because we had this protection from these treasuries coming through. So if you look, our expected return on treasuries coming through is actually probably, well, it actually is higher than 9.2% in rands going forward. And I'll break that down for you. So if you look at treasuries on that basket, the current yield is about 4.4%. If you take so if you look at our expectations, so that would be the yield, that 4.4%, that dark blue line. If you take the gray, so the gray would be the rand depreciation against the dollar over time, okay? How we price that in is just forward rate differentials, okay? So that's just kind of the market's pricing that in for us. That's another 3 to 4% a year estimate on average. But then if you look at, so let's say over the next year, okay, this is just the 1 year out. Let's say you just had those, so you had no rate. So market's predicting 325 bip cuts just over the course of 2024. It's expecting another 1% next year. But let's say through the course of the next 12 months, there was no cuts. You're still going to go get about 7% in rands on those treasuries because you're getting a 4.4% dollar yield plus a weakening of the rand to the dollar over time. Now, admittedly, it is volatile, but we kind of just conceptually, we're taking from equity and investing in these. So you're expecting with just like no rate cuts, a kind of a 7% return in rands. Our base prediction, we're not as dovish as the rest of the markets. We're not sure if rates will come down as quickly as what the market's predicting. But even if they only come down 225 cuts over the next 12 months in the US, you would get your 7% from the yield in the rand, but you'd also get another 8% from the capital value of those bonds coming down. So if you look at that basket, the duration on that basket of bonds is sitting at about 15 years, which means that for every 1% cut, you're doing about a 15% return in capital. So on a 0.5% cut, you're doing about a 7.5% return in capital. It's a little bit more complicated. You get a bit of roll yield and things like that, but roughly speaking, all else equal. So that's how we get to the 15% number. So it's essentially the 7 plus another 7.5 to 8%, you're getting on to 15%. That would be our base case for US Treasuries. If you had the bull case, now we call it the bull case, but this is the market expected case. So the market is expecting US rates to come down 2% over the next 12 months, essentially. You would actually have that 7% return, but you would also have another massive kick in the capital. So in a bull case, you could go and do 37%. So where is this likely to happen? We call it the bull case, but it would actually be potentially if you had panic in the markets, for example, the equity markets, and the Fed was actually forced to drop rates quicker than it needs to. So if you look, as I was saying, last week, futures are pricing a 50 basis point cut in the Fed in September. Now they're back to it. So they were at a 25, they went to a 50, now they're back at a 25. But if you actually saw real pain, like I say, that was a panic move in the markets. But if you actually saw real sort of pain in the markets, you could see the Fed cutting a lot quicker. So that's why you get these massive rallies. That's why you see these massive rallies that you do in the treasury markets in times of panic. So that would be like a good protection in the portfolio for us. But even without that, even if you just saw like sort of normal benign markets, benign economies, the status quo carrying on, the Fed's already predicting to cut. So let's say they don't cut as quick as they want to. You're still looking at a 50 basis point cut over the next 225 but cuts over the next year. So we still think, if you're getting 15% out of the equity markets over the next year, that would be a good. You would be quite happy and chuffed with those returns. So we don't believe by selling some local equities and buying offshore treasuries, we actually don't believe that we're reducing the expected returns of the portfolio at all. You actually probably, in some instances, you could actually argue probably increasing the expected return on the portfolio. But you're also having that nice protection in terms of drawdown. So just adding a little bit more protection into our portfolios. So that, I did send out a voice note last week about the trades that we made. So we moved about 7% of our enhanced opportunities portfolio from local equities into US Treasuries to give a nice hedge. And that obviously filters down into other funds as well. So obviously, you guys have access to the team if you want more details around that. But that essentially wraps it up, guys. I have been roughly an hour. I don't want to keep you too long. I know you guys are all busy. Also, the weather outside is looking pretty good. So yeah. But yeah, all the best. If there's any questions or anything like that, happy to answer those. For all of you that need to obviously leave the call, you will get your CPD points coming out. We will apply for those and you will still get those. So anyone who's keen to hang around for a chat, you're welcome. But thank you for your time again.
Oh, thanks, Paul. Yeah, if anyone does have any questions, you're welcome to put on your mic and ask, or pop them in the chat, whichever you'd prefer, and then we'll work through all the questions.
Thanks, guys. All the best for those of you who need to go. Sarah, how do you want to do this? Do you want to?
So it doesn't seem like there are any questions yet. Maybe you could just, because I think it could come up as well, would be if interest rates do start decreasing in the coming year, how would local bonds react to that? Because we have discussed the offshore component. If you can maybe touch on the local components a bit.
Well, you see, that's the great thing. So what our MPC will do will be, it's really dependent on what the Fed does. So if they start to drop rates, we will follow suit. So inflation here, as I mentioned, it's kind of, we don't have an inflation problem. We're very much within the midpoint of our target range. So all boxes checked in terms of controlling inflation, which is what our MPC's mandated to do. We're good to go. The reason they won't drop rates yet is they just want to protect essentially the currency. Okay. We've got you want to protect that premium because a lot of money. So if you've seen over the last couple of months, a lot of money's been reinvested back into our bond market. You saw that re-rating in our bonds. That was actually a lot of foreign investor money coming back into our bonds, a lot more confident about our market. So you saw that re-rating. So what you would find is if they start dropping rates, we'll keep that differential the same, but we would drop with them. So if we drop with them, you'll see our bonds railing as well. And we've talked a lot about our local bonds over our presentations. We didn't specifically pick them out for this presentation, but we still really like long-term bonds. They've done very well for us. Over the last year, I've been talking to a lot of the advisors who've known us for longer. We've been talking about 15, 20% a year returns in bonds. And actually, if you look back over the last 12 months, they've done 15% a year. They've done 15% over the last year. Yields are sitting at about starting yield of about 12%. So you've seen some capital appreciation, that re-rating in the market, but still on a forward yield basis from here, you're still north of 11% expected yield. That's if rates don't come down. But if rates do come down in line with what the Fed does, let's say they come down another 100 basis points over the next year, our duration's sitting at albeit it's about 6%. So you can take 6% and add it onto the yield. You're sitting at a plus 11. You're sitting at a 16, 17% return potential out of local bonds as well. So we still like local bonds. We're still holding on to our local bonds. We've taken a lot more duration into our income carve-outs, as you guys know. So yeah, still very positive around local bonds.
Awesome. Thank you, Paul. I don't see any questions that have come through in the chat, so I think we'll give it another minute, and if we haven't received any more questions, then we'll just wrap it up.
Yeah, so maybe just to kind of reiterate. So ultimately, in terms of all the asset classes, we're still fairly bullish. We do think you probably see a bit of volatility in the equity markets coming into the US election, mostly driven by the media. But ultimately, we think that plays out well, regardless of who wins. We still think the fundamentals of the US economy are quite robust, quite strong, and should the market should recover out of that. Local equities, you've seen a bit of a re-rating in SA Inc. after the election. So when I say SA Inc., local listed stocks that actually make their money here. Obviously, our market is quite polar. We've got our local stocks that actually don't make money here. They're not really SA stocks. Those would be Naspers, Richmond, companies like that, the miners. But your banks, your local retailers, they've actually re-rated quite a bit already. They're still offering a lot of value. You're still getting decent dividend yields on the banks, 6-7% dividend yields in some of those banks. So we like SA equity still. We still think that there'll be volatility, but there's still, I suppose, the uncertainty of how effective the GNU is. There's still a little bit of uncertainty around that. It's positive. We are positive about it, but it's still largely untested as a concept. Personally, I believe that it's the future state of South African politics will be this type of coalition type government. I think it's a signal of kind of mature democracy to have these. If you look in Europe, Europe's mostly governed by coalitions. So that's a positive. Ideologically speaking, I'm more of a libertarian, so I don't really want government setting up too much new legislation and policy. So if you have kind of a hung parliament, that's not kind of, if you have a coalition government and the coalition kind of gets hung or hung because they can't agree on things. I'm not necessarily opposed to that, just ideologically speaking. I think too much regulation, you're seeing in Europe, too much regulation is a problem. It's really causing huge demographic problems there, economically speaking. You know, we like local equities, but we think, you know, this trade that we've done now is not because we don't like the local equities. It's just that we think the bonds will give us the same kind of return profile, but actually with better risk adjusted metrics, if that makes sense. So it's not like we're selling because we don't like them. It's more we just see a better opportunity somewhere else. And then local and global bonds we still like very much as well. Also, another one we didn't talk about is property. We do obviously have property exposures in the portfolios. Being at the top of a rate cycle, we like property as well at the moment. So pretty much across asset classes, we're still fairly bullish, but just trying to protect the portfolios and de-risk them where we can.
Thanks, Paul. Maybe you could just elaborate a bit, because we did get a question from Rob Nevin in the chat saying, where do you see SA property going?
Okay, on that. Okay, perfect. Yeah, so good question. So we are quite, I mean, you know, if you look at property, just basically it's kind of half equity and half bonds, really, because it's got an equity component and the fact that you own the shares and the business is growing and it's growing revenues, it's growing rental streams and all that. But you've also got the income component of that. And that's very much tied to our bond market. So from the income component, I think that, you know, you're going to see a re-rate. So they'll generally command a premium on the bonds. So you would expect to get a slightly higher yield out of them. But remember that yield grows over time as well. So we think if you start seeing rates turning, you'll see property actually doing well as well. There's still, if you look at the equity side of it, the valuation side from an equity perspective, historically speaking, there's been quite a lot of accounting shenanigans around how they fair value, so how they value their assets on their book. So if you look at a price to book, like price based on fair value of the assets, been a couple of games of that in the past, but if you look rolling forward, that's kind of been washed out. And you saw that over the last few years. You've seen a big correction in the property. You've seen a run up recently, but before that, a big correction. And it was because of that rate or that valuation part of the component of how do you value your equity, your equity values relative to your property portfolio. But if you look, you know, speaking to guys on the ground, there's been a couple of transactions that have happened. So a good way to see if book valuations are too high or low is like compare them to real world transactions that are happening. You know, where there's a real buyer and a seller and the transfer of the property, because that gives you some kind of price discovery in the market. And of the latest, you know, Fortress has done a couple big ones, big transactions. If you see those transactions, they've actually been very close to, and in some cases at a slight premium to what the valuations recorded on the book, the actual book value of the property. So we think from a valuation point of view, a lot better than it was 5 years ago. We think a lot of those kind of accounting maneuvers have kind of been moved through the system, looking a lot healthier. And then also on the back of that, you've also got the bond market movements, which will bring down, which will command lower yields for capital, and you will probably see a rally there on the back of the interest rates. Just one caveat, obviously we do like property, we do own it, but we see it more of a subsector of equity. So we like to limit our exposures in the same way that we would limit our exposures to, say, US tech. You're not going to throw all your eggs in one basket. So we own it. It's sitting currently at about 5% in our high equity funds, roughly there, which we think is a good allocation. Global property, for the same reasons, we like global property. Global property and our global flex funds are sitting at about 7% at the moment. 7 to 10, it's a bit higher. It's about 10% actually at the moment. So kind of own it, but like it, but limit the exposure to it. You know, position sizing, as I've mentioned in portfolio construction, position sizing is crucial. Yeah.
Great. Thank you, Paul. I think that's the end of the questions. So yeah, unless anyone has anything else they'd like to ask, yeah, you guys are welcome to hop off. And thank you so much all for taking the time to join us for the update. We really appreciated having you here.
Yeah, thank you guys. All the best. Obviously, always welcome to reach out to me or the team. Always happy to chat. Hope we could provide a little bit of entertainment on what's generally a boring subject, but we hope you enjoyed it and added value to you and your clients. Thanks again for your time, and we'll chat soon. All the best.